Right, hello guys and welcome to another video. Today you find me in not such a jubilant mood because I've got some news to report to you, and it really seems like the UK house prices have started to dip. If you look at the graphs that they've got on the Halifax index, there's a definite inflection point. We're heading in one direction. It's clear that it seems to have topped out, and today I want to go through that data with you. But I've got some really interesting things. With every bit of risk, there's always opportunity, and today is no different. And today I'm going to give you some of my strategies about how I'm going to move forward towards the end of this video. So who am I? My name's Mark. I'm an entrepreneur. I'm a property investor. I've got about £3.5 million of property, and today we're looking at the Halifax house price index, which I'll put an image of over there. And as you can see, it's the first month this year where we've had a decrease month on month when it comes to house prices. So we're down 0.1% month on month. And you'll see lots of headline figures in the news and all this sort of stuff regarding the year-on-year increase, which is still standing at 9.9%. But I think there's some really interesting things we need to know about that. When you consider in the UK that we have 9.9% inflation, in fact, let me put an image up here, there we go, somewhere up there. I'm editing this all myself later, guys, so if it's not perfect, I apologise. When you consider that inflation's running at 9.9%, did we get any house price growth at all? I'm not sure we did, you know? But don't let that fool you. That doesn't mean that if you bought property with a mortgage, for example, you didn't make money, even in real terms. Of course you did. Let's say, for example, for me, I've got about £1.5 million worth of debt. If money became worth 10% less, like we're assuming it has become worth 10% less, well, 150 grand of money, if you like, of purchasing power has come off my debt, even though I haven't paid any of it off. So this inflation works for two reasons for us as property investors. Number one, the house prices have gone up by 10%. Number two, the value of our debt has gone down by 10% in terms of purchasing power for money. Obviously, in nominal terms, it's all about the same, right? Like 10% of growth and the debt has stayed the same in nominal terms. In real terms, though, the debt has decreased and the house price has stayed the same if you looked at it on a real terms basis. If house prices rose by 10%, inflation was 10%, in real terms, it's the same. The debt, however, in real terms has decreased. So you're still winning if you bought property with debt. Now, what I'm going to come on to next, though, is something that I'm a little bit more worried about. As I said, I've got £1.5 million worth of debt. 1.5 million, okay? I'm not over leveraged by any stretch of the imagination. And actually on this channel, what we like to do is just show what's happened to my portfolio. So since last time, I need to actually do a quick update because we're now down minus 0.1% this month. And I want to have a look and see what loss I've got on my portfolio. So we had August here. And this is September's, which was released in October, and this was the purchase of my flat, if you remember rightly, on my last video. So I'm just going to add all this together, see what the value is today, and then we'll see what I've minused off in terms of my net worth. So let me just grab out my trusty calculator. So we had 3.386, which is essentially 3.5 grand. It's not a massive loss, to be honest, not considering the growth we've had, which is the best part of 300 grand. So when we minus that off, 3.54 million. And I'll tell you what, next time we come back to this video, I'm going to sort all this out, put some new figures up there, and we'll just streamline it a little bit. Maybe I'll do a 2021, which was like July to December, and I'll just bring that all together, and then 2022 to date, and put all that in one place. And that way, that side of the board can just be freed up for other things that we're going to be talking about. So talking about debt, talking about the interest rates, talking about this decrease, interest rates are clearly part of that defining factor. And with inflation running at 9.9%, the Bank of England have a target rate of 2%, and they are willing to crash the economy, start to increase unemployment, make you and I a little bit poorer so we spend less money in order to reduce that inflation. So what does that mean for us as investors? That means this interest rate is starting to go up. And if I look at a 2-year limited mortgage, limited company, I was quoted in the last week 7% as a rate. That's a huge increase. Bearing in mind, in February 22, I did a 5-year fixed on about 350 grand's worth of debt at 3.29%. So much, much, much less. Now, that is the market betting on what's going to happen with the interest rates and banks insulating themselves against the risks of interest rates going up much, much higher in the short term. In the long term, even if you look at the gilt rates, we're looking at now 4-5% in the UK on a 10 or a 30 year. These are much, much higher than they were if you went back a year when it was averaging about 1%. So we need to keep a real close eye on what happens with interest rates, because that will really shape the economy and the amount of cheap money that there is out there. Now, my gut instinct is we're all addicted to cheap money. Not just me, not just you, the entire economy is addicted to cheap money. And because we've got this sort of policy of printing money and lending it out at cheap rates, and we have done for the last 12, 13, 14 years, lots of people have borrowed a lot of money, and not just people, businesses as well. And if rates go up really high, they're going to struggle to repay that money. And that's going to cause this inflation not only to go away, but it's going to cause a complete recession. So there's this fine line I think the Bank of England are trying to tread between reducing the amount of money that's out there and at the same time not making things absolutely dire. So this is all a bit doom-mongering, isn't it? And really, I have a negative outlook for the UK property market in the short term. And when I talk short term, I'm talking sort of 3, 6, 12 months, something like that. But there are things that I'm doing today, because I'm still looking to purchase something else today, and I have clients and people who want to work with me who are also looking to purchase things today. So what are we doing to sort of insulate ourselves against that? Now, this is what you've probably been waiting for in this video, how to make some money in this environment. Number one, you need to get a discount. Now, that doesn't necessarily have to be a discount on asking price, because, you know, you price the property low enough and it's already at a discount, but it does need to be a discount against the market. So let me give you some examples. The Newbury flat I bought, 160k, same utility as a 2-bedroom house, that's going for 260. I paid full asking price for that. I wasn't going to get it any cheaper, they weren't letting it go any cheaper. I paid full asking, but there's still a 90k discount on the same utility with a house. So for me, there was a discount built in there, and if prices again start to drop, I would expect the houses that are 260 to be dropping much faster than the flat that's 160, especially with that discount on utility. Other discounts you might want to look at is sort of, for example, something that has recently been renovated, where they might have bought it 2 or 3 years ago for a lot cheaper, and now they've renovated, they were expecting to get X, and X isn't going to happen anymore, and they're hearing all this scaremongering, maybe they're on bridging finance. There's the ability to just knock it down that little bit. And for me, what I want to be doing, and this is quite key to my strategy at the moment, is no work. Builders are incredibly busy at the moment, and they're very expensive. The price of an extension, for example, has gone up from about 1,500 quid a square metre, maybe 2,000. If you looked about 2-3 years ago, 2,000 a square metre, now you're looking at 3,000 a square metre. And that is not me exaggerating or trying to make it sound worse than it is. Materials have gone up, labour's gone up, it's got more expensive. And forget this 10%, it's not 10% it's gone up by, it's gone up significantly in the building. Mainly because there's been so much demand. The last thing I would do, so that I know that I get the property, I get it to rent out straight away, I want it to return cash straight away. So maybe I should put another thing on here. I want it to have cash flow. And if it's a single let, I want between, I don't know, 8 to 10%. And if it's a HMO, 15% plus. Somewhere in those regions. So I want it to cash flow from day one. I want to buy it, I want to get a tenant in it really quickly, and I want to start generating some revenue so that I'm insulated against any of these issues. The discount will insulate me against any drops, cash flow will insulate me against interest rates. Slow complete, this was the other thing I was going to say, is we all know that purchasing a property can take 3 to 6 months, somewhere in between those. At the moment, it's probably going to take me a little bit on the longer side. And that's because I want to see what's going on with the market. So I'm going to give the market a little bit of time. I'm going to spend a little bit of time making sure that my solicitors get everything in order. We're going to book our valuation, maybe a few weeks later than we might normally do. And I'm just going to slow that process down through to completion. And I think that way you get yourself, and I'm not saying let's take the mickey, you know, and I'm not going ridiculous with this, but if I'm buying something, I'm taking my time a little bit. And there's nothing wrong with that. You're more than entitled to take as long as you want to purchase a property. There's no rules, there's nothing like that. The flat that I bought took a year. And that wasn't my fault, that was the seller's fault. I had Harbour Avenue, which took me 2 years to buy. Would you believe it? I offered on that in 2019, completed in 2021. And that's because their forward purchase fell out of bed twice. I thought it was great because I still got to buy it at 2019 prices in 2021. It was a fantastic deal. Slow completing, it doesn't necessarily have to be unethical in my mind, but you can just take your time a little bit when it comes to instructing solicitors, when it comes to instructing conveyancing and maybe valuations and mortgage brokers and all that sort of stuff. It could just take a little bit longer. And that gives the market a chance to do what the market's going to do. If it drops significantly, time to renegotiate. If it increases, I'm probably going to increase the speed at which I'm completing. So where are we with UK property? Is it going to crash massively? Now, lots of people are saying maybe 10%, 15%, 20%. I personally think we might have a bit of stagnation. I think if you look at the graph, we've gone up like this, and we're kind of here at the moment. And my gut instinct is we're going to kind of do this. And the reason I think that is that there's still a massive demand for property. And there's still a massive undersupply of property. And when it ultimately comes down to it, I think it's a necessity for people. They need somewhere to live. They will prioritise this purchase and this expense over pretty much anything. Now, we don't want to be in new car sales right now, bearing in mind something like 80% of cars are bought on PCP agreements. And I was looking at a C-Class Mercedes, which used to be $350. You won't believe this. A new C-Class Mercedes, I was quoted £760 a month, PCM. And it used to be about $350. If you go back 4 years, something like that. And this was at like 3% APR, and it's now like 7.9 or something like that. And the difference is in A, the value of the car's gone up for a new one, but B, the financing costs are significantly more. Like on 50, 60 grand, you add on 4%, it's a huge amount per month. It's an extra couple £100 a month. So it adds up very, very quickly. So I personally think house prices, we're probably in for a bit of stagnation over the next 12 months. After that, I fully expect the taps to be put back on. I don't believe going into an election year, anybody is going to make us all feel poorer. I think if they do, whoever's coming in is going to do their best to make us feel richer. So my gut instinct is we're probably in for a bit of stagnation. But let me know your thoughts. Remember, no one actually knows. I don't know. All I do is I look at graphs, I go out into the marketplace, I get a feel for what I think is going on, and then I report back to you guys. So if you like this sort of content, if you like this sort of transparency, please give this video a big like. I will see you on the next one. Comment down below and I'll reply to every single one of you. And I'll see you very soon. Cheers, guys.